Unlike the Hindenburg that crashed and burned in the 1940s, her Nathan Anderson and his SS officers have been doing a blitzkrieg on quite a number of stocks lately. What's SS? Well, it's not the Schutzstaffen, but it stands for something equally powerful, short selling. And the Adani companies have felt the full force of it, with many of them dropping by 60% from their all-time highs.
Adani Power and Adani Wilmar shares hit lower circuits.
Adani Enterprises down by 30%, now lower circuit. Trading has been temporarily halted.
Share price dropping nearly 45% in the past 1 week.
Now, there is nothing new about short selling. In fact, the very first recorded instance of short selling in a publicly traded company happened over 500 years ago when in 1609, a Dutch businessman named Issac Le Maire speculated that the stock price of the Dutch East India Company is due for a big fall. His conviction hinged on the increased competition for the Dutch East India Company from the yet-to-be-formed French East India Company. Now, Amsterdam already had a system where traders could make money over a fall in the price of grain. Le Maire extended that same principle to stocks and sold shares in the Dutch East India Company without actually owning them, making it the first recorded short-selling transaction in history. But how does short selling work? Well, we've all heard the expression buy low, sell high, which is how we traditionally make money in the stock market. Short selling is this very expression, but in reverse, that is, sell high but buy low. In other words, it's a trading strategy where an investor sells a security today and buys it back in the future, hoping that its price would have gone down. In fact, the process of shorting a stock usually involves three players: A, the short seller; B, the broker; and obviously there is the market. So step 1 starts with the short seller identifying a stock that he or she believes will decrease in price over a period of time, generally a very short period of time. Step 2, the short seller would borrow these stocks through a broker and sell them at the stock exchange at their current price. And step 3 is when the price drops and the short seller buys back the stock at this lower price. He returns back the shares to the broker, pays him a small commission, and in the process, the short seller pockets the difference between the sale and the buy price. It's this very act of selling something you don't have or you are short of that gives this trading strategy the name short selling. Now, obviously, I have simplified this a bit, but to fully understand it, let's take this through an example and see how exactly it works on a trading platform. So a company, say Tata Coffee, is trading at slightly above 200 rupees a share. Now, short selling is basically selling, so we'll tap on the sell button, which gives us this window. Notice these two radio buttons here. CNC stands for cash and carry, that is, you want to take delivery of the stock, but that's not what we are looking for. Instead, we need MIS, or margin intraday square off. So there are two phrases here: intraday square off and margin. Now, intraday means within the day, and since we have sold the share earlier today, we need to square off, that is, buy back the share by the time trading ends, that is at 3:30 in the afternoon. The second word is margin, and we can see here this amount of 40 rupees and 39 paise, which is the margin deposit you need to keep with the broker. Now, in this case, the broker is offering a 5x leverage, but it's a number that varies from broker to broker and from stock to stock. Anyways, I'm now going ahead and selling 2 shares of Tata Coffee, and this order is executed at an average price of 201 rupees and 95 paise. Remember, I did an intraday short sale, which means I have to square off, that is, exit this position by the end of trading, irrespective of whether I make a profit or loss. So let's do that, and I move to the positions tab in my trading platform, and because I had sold those shares, I can see a -2 on the screen. I now press on exit, and quite rightly, the buy window opens up. Since I have until 3:30 PM to square off my position, I can opt to buy a smaller quantity, let's say 1 share right now, which brings me to an outstanding position of -1. Of course, every trader is expected to keep track of their position, but in this case, I completely forgot about it, and at 3:20 PM, the broker automatically squared off my position by buying a share of Tata Coffee. So this was just a demo, but if the price of Tata Coffee had tanked that afternoon to say 180 rupees, then after paying a small charge of 13 paise, I would have made a profit of 21 rupees 82 paise on this deal. And what's the money I upfronted? Well, just the margin, which in this case was 40.43 rupees, giving me an ROI of 54% just for that day. It sounds like a good gamble, doesn't it? But the real risk in short selling is not the upfront cost, but it's the risk of being wrong. For instance, if Tata Coffee had gone up to 220 rupees by the end of the day, then that would have amounted to a loss of 45%. to understand it from a risk-return perspective, look at this image here. So if the price of Tata Coffee were to go down, and that's what the short seller really wants, then the maximum he can gain is 201 rupees in this case. However, if the prediction goes horribly wrong, then there are no limits to what the short seller can lose. In fact, if the share price continues to climb and if the short seller continues to hold on to that security in the hope that it will eventually dip, then there is a high probability of a margin call happening. So margin call occurs when the value of shares fall below a certain percentage, in which case the short seller has to either deposit additional funds into the account, or he can transfer additional shares into the account, or thirdly, some of the securities can be sold. So these are some areas one needs to be wary of, but the bottom line is short selling offers big wins and even bigger losses, and as we'll soon see, there are many who have successfully executed it and there are many who have made good losses in the process. If you're getting good value from this video, then please do give this video a thumbs up. And if you aren't a subscriber yet, then do consider becoming one, as I can then serve you videos as soon as they are released and also share with you some investing strategies, tips and stories that I continually post in the community section. I think you and I have seen enough stock market movies to know that when someone shorts a stock, they're not just hoping for the price to drop, but they are likely to do everything in their power to make it drop. Remember our friend from the 1600s, Issac Le Maire? Well, after he shorted shares in the Dutch East India Company, he went all around town spreading rumors and lies. Oh, the construction of the ships is faulty, the crew is stealing the cargo, no, they don't have permission to trade there, etc. Of course, all this would be considered unethical even today, and while the techniques have changed, somewhere the intent is still the same. In Le Maire's case, it was an unsuccessful short. The French East India Company never got off the ground, and Le Maire suffered a huge loss from this trade. But like everything, short selling has its heroes, its zeros and the jokers. Let's start with the heroes, and we've all watched them on Netflix. The Big Short gave us the real story of three groups of people who shorted the housing market for billions of dollars right before the 2008 real estate crisis. As one might have expected, they made quite a bit of money in the process. But perhaps the most famous of all short sellers is George Soros. Also known as the man responsible for breaking the Bank of England, he began shorting the British pound when he realized the currency was overvalued and was artificially pegged against the German Deutschmark. As a consequence, Britain exited the European exchange rate mechanism, but by then Soros had earned a cool $1 billion in the process. When it comes to zeros, the story I like the most is that of Bill Ackman of Pershing Square. So Ackman had taken a short position of $1 billion against Herbalife, a nutritional supplements company. His contention was that Herbalife's multi-level marketing was a pyramid scheme, a Ponzi scheme that generated most of its revenue from fees rather than the sales of products. But to his dismay, Herbalife managed to improve its revenue, profits, and also its cash from operations over the next 6 years, and Ackman had to take a huge loss on this trade. And beyond these winners and losers are the jokers. Well, it's not an official term, but alright, I'm talking about something called a short squeeze. You see, until now, short selling was for the big players, institutions, hedge funds, but 2020-2021 saw an entire army of retail investors opening brokerage accounts, which at one point reached over 1 million new accounts in a single day. This brings me to Gamestop, and by 2021, this stock was excessively short sold by hedge funds who expected the company to fold and the share price would reach zero. However, what they didn't anticipate was a short squeeze, which is the term used when a group of people take the price of a stock so high that the short sellers find it difficult to cover their positions and even have to book losses just to exit that situation. In GameStop's case, a group of retail investors on the subreddit r/WallStreetBets had come together to drive up the price of that stock with the singular aim of causing major losses to hedge funds who had bet against the company. So while the hedge funds were expecting the price to drop, this unified action by retail investors caused quite a surge, and GameStop's share price jumped over 1,700% in January of 2021 alone. As a consequence, many hedge funds saw significant losses, with some even going bankrupt as a result of the short squeeze. The episode also prompted regulators and lawmakers to look at the practices employed by hedge funds and also the role of social media in driving market manipulation. Now, for most people, short selling as a concept is complex, it's confusing, but on moral grounds, people dislike it because by its very nature, it's about creating a downward pressure on a stock. In fact, such is the suspicion and distrust in the system that during the 2008 financial crisis and again in the 2020 COVID pandemic, many countries banned short selling at least for a few months. But on the flip side, it is also argued that short selling actually makes the financial system a lot more efficient by exposing overvalued and even fraudulent companies. Another utility of short selling is that it acts as a hedge, an insurance of sorts, and helps neutralize the impact of sudden market movements, thereby reducing portfolio volatility. In fact, here's a technique I read while researching for this video. So say there are two companies from the same industry and you think one of those, let's say company A, is going to do a lot better than company B. Now you could have invested in company A, but you're also worried about the market crashing or a bearish cycle in that industry. So what do? You go long, that is, you buy shares in company A and simultaneously you short shares in company B, ensuring you can benefit from the difference in performance. However, unless you're doing something like this, there is no second guessing that short selling is risky, and it might be the riskiest thing you ever do because when we short a stock, the profits are limited but the losses are unlimited. But there is big money to be made if you get it right. So understand the risks, evaluate the odds, be very meticulous with your research and then decide. Oh, and whatever happens to Hindenburg and Adani, you'll definitely find an update on my channel. So be sure to press the like button and subscribe to it. Until then.